The AIM market here in the UK has been a really good place for investors to be, and it seems to be continuing into the summer. Chris Boxall joined us now from Fundamental Asset Management. Chris, welcome.
Oh,
You're steeped, of course, in the AIM market and these relatively smaller cap companies. What is it that's going on at the moment which has brought about this success rate?
we've had just a really good month for IPOs on AIM. I had 16 IPOs in July, and that's a record. And well, not a record, but it's the highest level since December 2014. Now, AIM has struggled to attract new companies over many months, and now we suddenly have this rush coming through. Question is whether that was a sort of summer rush to get in before the holidays, but nevertheless, it's still really encouraging. So 16 new arrivals, 5 departing companies, and AIM itself maintained its level, circa 147 billion value across 837 stocks. So the average AIM market cap now is about 175 million a company, which is per company, which is quite large and sort of double where it was from a few years ago. But yeah, great to see some newcomers.
Yeah, absolutely. If I can, I want to push you on where we're seeing these in terms of sectors, because we, with IG clients, have been talking a lot about technology companies, of course, and we've seen a lot of tech companies come to the market. Has it been skewed towards the tech end of investing, or is it a broader spread than that?
There have been a lot of tech plays and a lot of software-like companies as well over the last few months, not just only in July. But I think what's really interesting about July and those 16 newcomers is the vast number of sectors they come from. And I've just got them down here: engineering, medical diagnostics, venture capital, beauty and personal care, vehicle telematics, fire safety, intellectual property, people monitoring, lithium development. Perhaps that's a bit of a throwback to where AIM was in the resources side, and also building materials. UK building materials have been very popular on AIM. Clearly, I think that's an area that's going to boom, and companies have taken the opportunity to list. But yeah, so that's a pretty eclectic bunch. Valuations stretching from way back down at 17 million market capitalization, that's 1.7, right up to 800 million plus. Now that is very unusual, I think, and it's worth probably sort of focusing on that point, on the large value of the IPOs.
But in fact, AIM is now, it's got quite a few billion-pound companies on its books, hasn't it? I mean, it's a market that now seems to be working. I think we discussed this before, actually, working beyond its original remit when it started 20 odd years ago as the alternative investment market, and it seems now to be including a lot more of these larger companies. Does that mean that the overall investment picture has stabilized a bit more? Because I guess in the beginning, when no one really knew what was going to happen to it, it was a little bit of a sort of suck it and see type of market for a lot of investors. But does this bring a stability, do you think, that would otherwise not have been the case?
Yeah, very much. AIM used to be termed sort of wild west of investing, and that's no longer the case. And if anything, I would say over several years, it's become a little too boring and staid in many respects. And so it is good whilst it's good to see these very large businesses join in terms of market cap. I mean, they're still very small companies. It's just their market capitalization is quite substantial, and they would conceivably, or some of them always slot into the lower levels of the mid cap index. But we're also seeing some early stage businesses as well, and that's very important. I think AIM should be all about rapidly growing early stage companies that need funding, and it's good to see those come on board as well. So the mix is great, and it gives the investor base an opportunity to really take their pick. Where do you want to go? Into more mature, slower growth, steadier, less risky, or we'll have a little flutter in some of these earlier stage plays.
Mm. Some of them, in amongst those that have listed recently, some high-profile companies like Victorian Plumbing, for example. I've got a chart here for Victorian Plumbing. It's come to the market just earlier on in the summer, so we don't have much in terms of the trading. It has actually dropped a little bit from where it listed. I mean, this is what, 850 million pound valuation in its June IPO. And in fact, I think it did actually rise beyond that at one point. But I mean, this is actually quite a relatively mature business, although it's still actually owned by the original founder, isn't it?
Yeah, I mean, it's still the founder still dominates the shareholder register, although that's a slight issue with us with a lot of these large floats. We've seen very big secondary sell downs, which implies that, well, are they priced to perfection a little, somewhat? And we saw in the case of Victorian Plumbing, I think we saw a big sell down by the founder, over 200 million, and that's taking quite a lot off the table. I think it was closer to 280 million. So that's taking a lot of money off the table. And we saw that with some of the others as well. Big technologies, another large IPO, 576 million odd went on listing, big secondary sell down, but not of the founder. The founder actually didn't take too much out. And Revolution Beauty, circa 500 million. I think we saw some secondary money there as well. And what probably best to expand upon that. What do we mean by secondary money? Company lists, it either raises new money for the company to support growth, or you see the existing sellers take the opportunity to sell some of their stake. And we're always slightly wary of that when insiders sell a large stake in the company. Again, it couldn't indicate that it's that the valuation is sort of a little bit toppy, and they're taking advantage of a somewhat frothy market to get rid of some stock.
Yeah, let's pick up on the point you mentioned earlier about the fact that we've got an average market cap now on AIM 175 million. My understanding is 830 odd companies I think now are listed on AIM. Let's take a look in some more detail about the spread, because as we said, there are some companies worth over, I think 5 billion, the biggest company or something at the moment. But of course also there's lots of little companies as well in amongst that. How big is this market in terms of the overall capitalization?
Well, it's still a tiddler. I think whatever is 140 odd billion is only the equivalent of, I don't know, a fraction of one of the oil giants or something. So it's yeah. very small in the grand scheme of stock markets, and it's very small still in compared with the private equity world, which is sucking in an awful lot of capital. And I think that has been the issue for AIM. It's been a problem for AIM over recent years, that it hasn't been the venue of choice, shall we say, for many businesses. Private equities sucked up a lot of smaller ones that may have joined AIM. Venture capital monies come in and help fund earlier stage ones, which previously might have joined AIM. So you've had that issue. But for private investors, that's still a chunky market. And of course, you've got the big inheritance tax planning attractions for that as well. So 140 odd billion is not to be sniffed at. And if you're, as I say, a private DIY investor or a small scale manager, there's a huge amount of investment opportunity there.
Just talk to us a little bit about the biggest company. I think you tell us that is it China, Hutchison China Meditech, which I think is worth about 5 billion, isn't it? Why is this on AIM? What's it do, and what's it bring to AIM? The sheer size of it. We hear a lot about Chinese companies, of course, wanting to list in the West, and indeed, there's been a lot of negative headlines, of course, around some of the Chinese listings in the Western markets. Are we happy about going into a stock like this?
Well, HUTCHMED as China, as it's now called, it was Hutchison China Med, has changed its name over recent times. Has been on AIM a long time, and it's been actually used AIM to great effect. It's also dual listed, I think, now in Hong Kong when it raised further capital, which has seen its help lift its market capitalization. And you're right about overseas listings, not just China listings. A few years ago, there were a huge number of overseas listings on AIM. The boom time of the market, 2007-8, and then of course everything fell out of bed. But you had this huge rush of overseas listings over a number of years, and many China stocks, and most of them were somewhat questionable and are no longer listed. But HUTCHMED has done really, really well. It's used AIM to great effect. It's got dual listings. It's got a dominant shareholder as well, which is a reputable dominant shareholder, and I think it's been well supported. And it's actually taken over the top spot from ASOS. And ASOS has been top dog on AIM in terms of market cap for quite a long time. So this is good. This is quite a replacement. It's interesting to see Hutchmed now, to hit the top heights, and hopefully go on to even greater things. But it wouldn't, Hutchmed wouldn't necessarily qualify for inheritance tax planning purposes. So it's not a business that we could invest in for our IHT, for example, our IHT planning book. However, it has got appeal from a general investment perspective.
Yeah, you mentioned big technologies. How about that from an investment an inheritance tax planning position? Because this is a unique market where you can get advantages, can't you, for IHT in some of these stocks. I know that big technologies, as I said, you mentioned it a short while ago. It does have sort of family money in it, doesn't it? Which I think is one of the qualifications. Is that right?
It's not a qualification per se, but it's interesting. We think for us, it's a key attraction when founders and families are still involved, have a meaningful equity stake. We love that. That's one of our primary investing criteria, is to follow founders. But whilst it's not an IHT planning requirement, it often goes hand in hand with inheritance tax planning qualifying stocks, because it's often a reason for, say, more elderly founders. That's not the case with big technologies, but more elderly founders to stick around in those companies because they're picking up the estate planning benefits as well. I mean, one AIM stock where the founder has never sold, RWS Holdings, it's got about 30% stake. He's quite elderly now. That's great for his estate. But yeah, big technologies, I think, looks interesting, and it's come onto AIM, with a bit of a fanfare. The share price has moved sharply upwards, and it looks very interesting. The founder, Sarah Murray, has retained, as I mentioned, a meaningful equity stake, despite selling down a little bit. But she also was involved in the founding of Confused.com, so a bit of a track record in the technology space. Their product is called, the key brand name is called Buddy. Buddy is a smart tag which addresses actually the criminal justice area. So it's used as a tagging device. Not a great name really, Buddy. I don't think the wearers of the device will be terribly enamored by that term. But yeah, it's a big business. It's got customer base across the justice sector in numerous jurisdictions, not just the UK. So big growth potential globally, big growth potential in other sectors as well, healthcare, care assistance as well, and quite an interesting stock. That valuation looks pretty punchy, as does everything that's interesting. But yeah, a 500 circa near £1 billion company that's come on AIM, you would have never seen that 10 years ago, not even 5 years ago.
Just one final question in terms of stocks. What about electric vehicles? We're hearing a lot about electric vehicles recently. In fact, I think China's just come out with data to say that it's got a record amount of sales on electric vehicles. Do we have much to chew on that particular sector on the AIM market? Any stocks you're following?
Oh, another one of the new listings, Sciatica Group, which joined at the same time in July. Much smaller, earlier stage, no revenues. Modest revenue, should we say, loss-making, but it's got a patent technology for electric motors and the primary focus is on motorbikes, mid-sized motorbikes, and last sort of stretch delivery vehicles. So it's addressing a very, very large market, which is great to see. So many AIM companies, as I said, are very UK centric. This is addressing a very large global market. EVs are very, very hot at the moment. It's a very hot topic, and it's an interesting company to follow. And this one's raised largely new money to help support its growth, to help build out some production facilities and extend its reach.
So what about the outlook from where we go from here? You were talking there about some of the possible IPOs we've seen ahead of the summer lull that we are all expecting around this sort of time of year. How do you see the rest of 2021 developing? I'm not hearing any negative news necessarily about the equity markets. A lot of people are saying, of course, there's nowhere else to put your money at the moment. But do you see AIM as a good place to be? Or rather, I should say, perhaps maybe you would say that because that's where you're operating. But give us some evidence to suggest that it is a good place to have money.
I think for UK investors looking at growth stocks, who want to stick on UK markets, AIM is a great place to be. You've got an additional tax planning benefit as well. Admittedly, valuations in some areas look stretched, and I think that's always the issue with IPOs. How are they valued? We, as a firm, are reluctant investors on IPO. We'd like to see even small companies prove themselves on public markets. They're generally all packaged to sell, aren't they? You're coming onto the stock market and you just delivered wonderful growth. Everything's rosy, and it's all and to drive that pricing, that valuation. So we like to see them prove themselves. That may mean you miss out on occasional bounces on listing, but better that than seeing stuff fall off precipitously afterwards. So we like to see them improvements, and we think the outlook's very good. We think IHT money, ongoing money, is very supportive as well. So after they've listed, after they've proven themselves, you'll see a lot of people buying, and there's a regular flow of buyers and liquidity because of that inheritance tax planning attraction as well.
Chris, just one thing. I really do have to ask you this because it is such a hot topic at the moment, and it is how we pay for COVID. There's been a lot of suggestions as to what Rishi Sunak and the Treasury are looking at in terms of ways to try and find the ability to be able to cut out money that's been offered back in the market through tax advantages. Do you see IHT as coming within the range and in the crosshairs of the Treasury? I think I'm right in saying a couple of years ago there was some suggestion that the Treasury was looking at this as a way to cut back on some of the tax advantages in the market. Do you see that as still as a vulnerable target, do you think, for the Treasury, or do you think they'll keep this inheritance tax planning through these small companies?
We've been investing in AIM for IHT for more than 17 years, and the concern has been ever present for 17 years. I mean, every year we're slightly concerned what HMRC is going to say, what the Chancellor is going to say on this point. And you're right, the Office for Tax Simplification addressed this issue. Is the IHT benefit really supportive? Is it really as relevant as it used to be? And it's easy to say it's not for a 3, 4, 5 billion pound company. That's driven by large institutional money, not by smaller inheritance tax planning. In terms of however, we feel it would have a severe impact on AIM because of the point I mentioned earlier about the ongoing liquidity. There is always a reason to keep supporting small companies if you're given a bit of a tax boost. And we saw that over COVID. Lots of new money raising, and people were happy to support them. And a lot of those supporters were IHT planning investors. So they're sort of support of last resort, but they're happy paying in. So I think it's there, and you're quite right, it's ever present. It's a bit of a drop in the ocean in the grand scheme of a tax take. I mean, it's a fraction of a percent. Yeah. I feel, if anything, they should be chucking more incentives to smaller companies. We mentioned the EV company developing an electric vehicle motor. That should be given enhanced tax benefits to attract money, not necessarily curtailing them. But yeah, who knows? It's been there all the time.
That could be a very hard sell to HMRC, but we'll see what happens. Look, Chris, it's a pleasure. It's a pleasure. Thanks for joining us, Chris. It's Chris Boxall, the founder and one of the senior partners at Fundamental Asset Management. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.